tech leadership finally blinked, just as central banks and energy markets rewired the macro backdrop for equities. You're watching vTalkInsight, Equity Pulse Daily for June 17, 2026, where we connect those shifts to the risk and opportunity set across global stocks. The macro starting point for equities is a tug-of-war between still sticky inflation and building disinflation forces. Core inflation in the U.S. is hovering near 3% against a 2% target, and supercore measures are running closer to a 5.5% annualized pace, while import prices have jumped about 6.6% over the past year. At the same time, market rents have only been growing at roughly 1% for nearly 3 years, which should gradually lean against inflation prints as leases reset. Forward-looking inflation indicators are also mixed. Labor market and housing trends are viewed as the most reliable guide for price pressure over the next year or so, and both still look firm enough to challenge the idea of rapid disinflation. Add in several quarters of above potential U.S. growth, a fiscal deficit around 6% of GDP, and resilient consumer demand, and it becomes harder for the Federal Reserve to lean into early rate cuts. Overlaying that data is a regime change at the Fed under Kevin Warsh. He is expected to overhaul the post-meeting statement, potentially shorten it, and shift away from the dot plot, all while dialing back forward guidance and public appearances. That could leave equities with less explicit signaling, more day-to-day policy uncertainty, and greater sensitivity to each jobs or inflation release. Markets are already wrestling with this new regime. Front-end Treasury yields have repriced higher on the view that rate hikes early next year are back on the table, and a majority of surveyed former Fed officials see scope for up to 50 basis points of additional tightening this year. At the same time, the Bank of Japan has lifted rates to 1%, the highest since 1995, pushing Japanese government bond yields up and effectively raising the global developed market yield floor. For equities, that combination of less guidance, sticky inflation, and a higher global discount rate sharpens the focus on earnings durability and valuation discipline. The second big macro swing factor is energy. Oil has entered its longest daily decline of the year, with Brent slipping below $80 a barrel as optimism grows around an interim U.S.-Iran deal to reopen the Strait of Hormuz. Physical and financial players are cutting exposure and inventories, and Qatar stands ready to ramp up liquefied natural gas exports once shipping lanes reopen, all of which is easing headline inflation pressure for now. Under the surface, though, the supply story is more nuanced. Restoring flows through the strait is expected to be gradual, with perhaps 30 to 40% of Gulf exports back within weeks, 80% over a year, and a final 10 to 20% taking years or never fully returning. Global inventories have been drawn down by more than 1 billion barrels. U.S. emergency reserves are at their lowest since the early 80s, and both the U.S. and China still need to rebuild strategic stockpiles, which argues for a higher structural floor in oil over time. Those cross-currents are playing out in other assets too. Gold has extended its rally, supported by falling oil, moderating near-term inflation expectations, and survey evidence that almost half of central banks plan to add to their gold reserves. For equities, cheaper energy and lower bond yields create near-term breathing room, but the fragile geopolitics around Hormuz and depleted buffers mean inflation and rate volatility can reappear quickly if the ceasefire narrative disappoints. On the growth side, the world looks increasingly to speed. China's latest data signal a deepening slowdown, with retail sales back near pandemic-era lows, home prices falling faster, and fixed asset investment missing expectations. Domestic demand is soft even as export and tech sectors prove more resilient, a pattern that has pressured Hong Kong-listed Chinese stocks and raises questions for global cyclicals and European luxury names heavily tied to Chinese consumers. The U.S. picture is almost the mirror image. Unemployment is low and banks such as Royal Bank of Canada are seeing strong lending demand in the U.S., yet consumer confidence is at historically depressed levels. Persistent high costs in housing, utilities, food, and healthcare are squeezing real spending power, and misses like Dave & Buster's revenue shortfall and double-digit share price drop underline how vulnerable discretionary dining and entertainment remain. Equity markets are digesting these divergences through rotation rather than outright de-risking. The S&P 500 slipped about 0.6%, and the Nasdaq 100 fell roughly 1.5% in the latest session, with semiconductor indices down more than 5%, yet the Dow closed at a record high, helped by a 4% gain in JP Morgan. Equal weight S&P indices, small caps, and industrials are at or near all-time highs, and cyclicals like financials, industrials, and even some utilities are outperforming while mega-cap tech and energy lag. Underneath that healthy breadth, valuation tension is building. U.S. equity market capitalization has climbed to more than twice the size of the economy. Equity risk premia have compressed even as bond yields remain elevated, and investor positioning is increasingly driven by fear of missing out rather than caution. Dividend-focused strategies are delivering double-digit returns, and European indices are making new highs on solid volumes. But the combination of rich multiples and a relatively calm volatility index near the mid-teens leaves limited margin for policy or growth disappointments. The dominant structural story for equities remains artificial intelligence. AI-related investment now accounts for roughly half of U.S. GDP growth, with hyperscalers and corporates racing to build data centers, secure power and cooling, and lock in chip supply. That has driven a surge in syndicated bank lending, high-yield issuance, and equity raises, with recent transactions like NVIDIA's bond deal illustrating how strong demand for AI funding still is. Semiconductors sit at the heart of that trade. The Philadelphia Semiconductor Index, along with names such as Micron and Western Digital, recently notched record highs, reflecting optimism about AI hardware demand even after the latest pullback. Memory has shifted from a purely cyclical business to one where customers sign multi-year contracts and pay upfront to secure supply, while companies like ASML and other European technology firms benefit from the broader global chip build-out. Policy and corporate strategy are amplifying the trend. U.S. incentives for domestic chipmaking are pulling capital back onshore, supporting industrial and semiconductor names tied to new fabrication plants, and mergers such as Qualcomm's talks to buy AI chip startup Tenstorrent, Salesforce's AI acquisitions, and SpaceX's purchase of Cursor show an arms race for compute and data. Meanwhile, AI deployment is already lifting productivity, allowing tasks that once required large teams and months of work to be done by far fewer people in hours. But this boom comes with important equity risks. The initial wave of AI Capex is inflationary, putting pressure on resources and supply chains before longer-term efficiency gains kick in, and some accounting treatments may be overstating near-term tech earnings, echoing patterns seen before the dot-com bust. Much of the infrastructure has been financed through private credit, where non-accruals are rising. Software exposure in business development company portfolios averages around a quarter of assets, and concentrated books are increasingly vulnerable to single borrower stress. Regulatory and geopolitical overlays add another layer. Tensions between Anthropic, the Pentagon, and U.S. regulators, as well as broader government intervention in AI, are raising political risk premia for leading platforms and could push some global capital towards sovereign-backed AI projects, particularly in Europe. Firms like OpenAI are running very large losses, underlining how dependent current valuations are on continued access to global markets, while fund manager surveys still show investors viewing AI as firmly in the boom phase. The equity primary market is reawakening just as valuations stretch. The Securities and Exchange Commission is moving to simplify IPO disclosure and reduce reporting burdens in an effort to reverse a decades-long decline in the number of listed U.S. companies. Coupled with strong appetite for capital raises from large tech and AI names, that means net equity supply is likely to rise over the coming quarters, changing the liquidity backdrop for equities. SpaceX is the lightning rod for these themes. The stock has rallied roughly 56% post-IPO, with its market value surpassing Amazon and price-to-sales multiples around 150, far above most established tech giants. Trading has been intense, with options volumes outpacing even the largest technology names, while a tight free float, heavy index inclusion, and a lockup expiry in August set the stage for continued volatility and potential pressure if insiders move to monetize gains. Beyond the headline IPOs, several single-name stories offer useful signals. Yum Brands is streamlining its portfolio by selling Pizza Hut's struggling U.S. operations to long-range capital, while Yum China acquires the still popular Chinese franchise. The deal removes a structural drag, as Pizza Hut's revenue share has fallen to around 12%, and its dine-in-heavy footprint has weighed on margins, allowing stronger brands like Taco Bell and international KFC to drive growth and supporting a positive share price reaction. In tech and media, Snap is pushing ahead with $2,200 augmented reality glasses aimed at developers, even as its share price is down about 30% this year and regulators in multiple countries tighten rules around youth safety on social media. Roku delivered a beat and raise quarter that underscored accelerating monetization before agreeing to a takeover by Fox, which reportedly structured the bid with governance incentives and tax advantages to secure the deal. Oracle, by contrast, came under pressure after reports that Microsoft walked away from a multi-billion-dollar data deal over security and compliance concerns, highlighting investors' growing scrutiny of cloud infrastructure providers. Finally, financials and credit are seeing their own idiosyncratic shocks. UK wealth manager Rathbone dropped nearly 16% after disclosing a potential £60 million hit from a regulatory review, while Fannie Mae and Freddie Mac were downgraded on lingering uncertainty about their eventual exit from government control. Job cuts at Robinhood and BlackRock point to a broader shift toward operational discipline rather than outright distress, fitting with a market that is still risk-on at the index level but increasingly unforgiving of governance, compliance, and capital allocation missteps in individual names. Pulling this together, equities are navigating a complex mix of sticky 3% inflation, a communication reset under the new Fed leadership, and a powerful but uneven disinflation pulse from rents and cheaper oil. Growth is diverging, with a resilient but squeezed U.S. consumer, a slowing China, and a newly hawkish Japan all feeding into a higher global yield floor, even as market breadth improves and cyclical sectors quietly take the leadership baton from mega-cap tech. At the same time, AI remains the primary earnings engine and narrative driver, with semiconductors, hardware, and select industrials benefiting from massive Capex, while stretched valuations, private credit stresses, and rising regulatory intervention keep the tail risk skewed to policy and funding shocks. Looking ahead, the key signals for equity markets are the first FOMC meeting under Kevin Warsh, the pace and durability of the Strait of Hormuz reopening, incoming Chinese activity data, and how the AI and IPO pipeline, including SpaceX, trades as lockups approach. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.